Welcome to hSenid Business Solution PLC Quarterly Investor Forum. This is for Q4 financial year 2024. Unfortunately, our chairman Dinesh Saparamadu at the moment is not available due to a flight delay, so he will not be able to attend today's session. So Nilendra will hope you all received the deck well in advance. So Nilendra will quickly brief overall situation, and then we can get into question and answers.
Thanks, Sampath. Hello, everyone. We warmly welcome you all to the fourth quarter FY2024 Investor Forum hosted by hSenid Business Solutions. We sincerely appreciate your participation today and look forward to actively engaging with you over the next hour or so by addressing and clarifying your queries. A kind reminder to all that the format of the IR call will be as per the practice that we started in our Q2 call. That is, there will be no formal presentation made, and the entirety of the call will be devoted to addressing your queries. And also, as promised and notified to you via email, the quarterly earnings presentation was uploaded to the IR website shortly after the release of our quarterly filings. Before we get into Q&A, we will have some opening remarks summarizing the performance of the fourth quarter. To give you a quick rundown of how Q4 has turned out, we recorded a revenue of 433 million LKR for the 3 months ended March 31st, 2024. This is 11% year-on-year growth in revenue in LKR terms and a 21% year-on-year growth in USD constant currency basis. We need to remind the audience that the LKR strengthened almost 8% or so against the USD during the period under review. Full year revenues came in at 1.64 billion LKR, which was up 12% in LKR terms and 20% in USD constant currency terms. People's HR Cloud, which remains our core focus, recorded a year-on-year growth of 36% in LKR terms and 51% in USD constant currency basis. Also, with the closure of the quarter, our core exit ARR, annual recurring revenue, is now at $3.1 million USD, reflecting a 39% year-on-year growth in USD constant currency terms. New deals for the quarter came in really strong at 1.6 million USD, a record high in recent times, with demand driven by Middle East and Africa and South Asian regions, recording a 212% year-on-year growth in new deal closure value. Of course, the bottom line for Q4 was significantly impacted by LKR 102 million in one-off and non-cash items, which comprised 57 million LKR in FX losses, 22 million on gratuity provisions, and 23 million LKR on deferred tax expenses on account of debtor receivables provisions being reversed. Our continuous quarter-on-quarter margin improvements that we highlighted and witnessed from Q1 to Q3 were unfortunately reversed in Q4. More of that explanation is given on the slides due to the margin contraction on account of the LKR appreciation. With that, the normalized EBIT and EBITDA margins for Q4 were at -19% at EBIT level and -8% at EBITDA level, respectively. With that, our opening statement comes to an end, and we would like to now move to the Q&A. I think we have some questions coming in, so I'll start with that. People's HR on-premise recurring revenue during the quarter. We'll get you the exact figure on that. So, on a total revenue basis, during fourth quarter, we recorded about roughly 85 million or so, approximately total revenue. The recurring component of that, Ravin, if you can get me the number.
When it comes to Government of Uganda project, we managed to complete phase 2, and we kick off phase 3 as well. So we recognize phase 3 license revenue, like, in Q4. And of course, implementation revenue will move to Q1 next financial year, that is current financial year. And the phase 2 is fully done now. and sites are live successfully.
Just to answer the previous question, the total recurring revenue component on the on-prem business amounts to 82,000 USD. So again, if you look at, let me go into slide 12, which shows that. So this is slide 12 on the investor presentation. The recurring component of the on-prem business is highlighted in row number 5, and for quarter 4, that is about 25 million in LKR, and there was a 57 million non-recurring component that is partially coming out of the GOU project, as Sampath mentioned. Going back to the Q&A, how much and when do you expect to recognize implementation revenue from Uganda project phase 3? Sampath, do you want to take it?
Yeah, values, Nilendra just mentioned the values. So Uganda phase 3 project, we kick off March 2024. So I'm also heading to Uganda today because there's a critical meeting happening with the government. So team is in Kampala these days. We already started the phase 3 activities, change management exercise and other implementation activities. So we are planning to fully recognize phase 3 revenue during first 3 quarters of current financial year. So then the project will be fully done. We already started the support activities of phase 1. That is somewhere around 100,000 USD per year. We are planning to kick off phase 2 support activities effective from 1st March 2025. That is again $40,000. And phase 3 support from 2026 January. That is 60,000 USD. So the overall addition to recurring revenue would be 200,000 USD, and will continue from 2026 January. But right now we are getting 50% of that. That is 100,000 recurring revenue for the current financial year. So yeah, other than the phase 3 license value, which we recognized for Q4 last year, rest of the payments will come or recognition will happen during current financial year. Ravin, if you can mention the value of that.
Total phase 3 value is 491,000. Out of that 147,000 and 147,000 have been recognized in the Q4. So the rest of the thing will be will be recognized in the over a period of during this 3 quarters during this financial year basically.
I think there's a follow-up question on the on-prem deal closures. Does the on-prem new deal closures relate to Uganda phase 3? If not, when do you expect to recognize licensing revenue on these 1 million USD on-prem deals? How much do you expect to realize as licensing revenue? So out of the 1.6 million on-prem deals, I'll go to the new deal closure slide for everyone's benefit. Out of the 1.6 million in new deal closures, roughly 492,000 is the amount relating to phase 3, which we secured during the last quarter. 1.1 million balance component basically is net new deals across both on-prem and the cloud business. The total amount from the cloud business roughly stood at about $600,000, and the balance coming from on-prem. So obviously an on-prem, like we explained during our last call with some additional slides at the beginning, you will typically have licensing revenue recognized upfront in the first couple of quarters. So on the on-prem deals that were closed in Q4, you would see revenue getting recognized fairly upfront. It's front-loaded, so Q1 and Q2. And of course, on the cloud deals, like we explained last time, it'll be over a longer period of time, but of course with the benefit of the accumulation, because it is entirely subscription revenue, recurring revenue. Going back to the Q&A. I think we've answered questions up to now. If there are Any participants who want to pose a question, we can take that.
So there's another question on progress of the new deal closure. So historically, Q1 is a very low quarter, like, if you really look at deal closure point of view. But we are investing time and energy in both the regions, that is APAC region as well as MEA region. APAC region also, like, very specifically few countries like Philippines, Indonesia and stuff like that. So we are building our funnels. So, like, there are two areas. One is the demand generation and one is the closure. So we invest quite a lot of time on demand generation at the moment because our funnels are now becoming very strong. So we are expecting a good set of closures towards Q2, but Q1 also, like, we are planning may not as Q4 last year, but of course, like, we are planning to close good set of deals, like, in APAC region as well as MEA region. But Q2 onwards, like, we are expecting a steady flow of deal closures because funnels are becoming very strong.
There's a question on the growth, the factors contributing the growth. Out of the 50% year-on-year growth in USD constant currency in PHR, could revenue grow in PHR cloud? Revenue growth, what is the contribution of price growth? So I assume the question is on the effect of the repricing program. If you go back 12 months, exit ARR was at about 2 million. And we explained that we were able to achieve about a 7% growth on the 2 million ARR base through the price increases. If you look at the 50% year-on-year growth, I would say there is 7% or less than that is contributed by price growth, and the rest is purely growth coming from two areas. One is new deals, and then the existing order book getting converted into subscription revenue paying customers. There is one more question. What has caused the 13% quarter-on-quarter increase in staff-related costs? Let me navigate to the respective slide. Yeah. So I'm assuming this question is on staff-related costs, the item below total cost of sales. We've gone from basically 117 million in corresponding quarter of the previous financial year to 157. The growth rate, of course, is 34%. I'm not sure where this exact number came from. Nevertheless, from a reasoning point of view, what we have inside cost of sales is bulk of the delivery team costs, and obviously with the significant payroll cost increases that we had to take as a result of the high staff turnover, the increasing personal income tax rates in the country, particularly in Sri Lanka. This basically led to the significant increase in staff-related costs. Nevertheless, we have been parallelly driving a efficiency improvement initiative where essentially we are trying to improve employee productivity so that with the existing cadre, we can essentially handle more work. There's a question on the reason for the increase in finance cost. finance cost for us predominantly is whatever interest costs on overdraft facilities that we use. We don't have any permanent debt facilities other than overdraft facilities used for working capital financing. So all the finance costs you see is predominantly those, and of course certain finance charges involved when it comes to our transactions overseas. Anything else to add on that, Ravi? Oh, yes. I think Ravin raises another important point. As per accounting standards, the interest costs of our lease, part of it goes as an amortization and a part of it goes as interest costs under finance costs. So the figure you see here, I would say majority of it is that accounting interest cost component of the lease rental that as per accounting standards are recognized under finance costs. There's another question on why was the selling and distribution expenses increased significantly against last year? Let me go to that relevant slide again. I mean, we can look at it as selling and marketing expenses as a percentage of sales. Essentially, this is the entire or a significant portion of the market development expenses we've been making. And this essentially has two costs. On the sales front, we've been building teams, in-country sales teams. And secondly, obviously marketing expenses. So this would involve digital marketing for lead generation purposes, sponsorships of HR events, PR activities, to basically make sure that our people's HR brand is visible to our ideal customers, ideal customer profile within these markets. Anything that you want to add there, Sampath?
Yeah, as I told you earlier, when it comes to sales, there are two aspects: demand generation and sales closure. So we are heavily investing on demand generation side because we need steady funnel for the future quarter closes. So we are heavily investing both the digital marketing initiatives as well as physical events in the region, both the regions, MEA region as well as APAC region, to make sure our future flows are strong. So we can get a good set of closures in Q2 to Q4. So that's why we increased the value. And on the other hand, as Nilendra mentioned, we did some recruitments in the region, in-country recruitments, especially sales and marketing area. So that also contributed to the high cost.
There's a question on which countries in the MEA region did new deals originate from in the Q4, and what are the main focus markets for obtaining new deals in recent future? Sampath, you want to take that?
Yeah, so primarily in APAC market, we are working on Philippine market at the moment, and we are just getting to Indonesian market as well, Indonesia and Vietnam. So we are investing heavily on product localization work for Indonesia and Vietnam at the moment, but we have done product localization and payroll localization for Philippine market already. Because of that, we are getting a business now from Philippine market. And we are expecting a similar flow in coming quarters, Q3 onwards from Indonesia market as well, then subsequently from Vietnam market as well. So these are the three markets we are growing. At the same time, we are getting business from other regional markets as well, like Cambodia, Myanmar, and stuff like that. So, but focus countries would be Philippines, Indonesia, and Vietnam. Philippines already giving us deals, and Indonesia we are moving towards that. So we are getting into demand generation process last quarter as well as current quarter. Vietnam market, we are doing the localization, and hopefully in Q3 we should be able to get into that market as well.
I think
Same time,
Sampath,
when
yeah,
it comes
the
to MEA
focus,
region,
yeah, that's right.
yeah,
Yes.
MEA region. So MEA region, primarily we are getting business from Kenya and Uganda at the moment. So that is East African belt. So we are investing time and energy in Uganda, Kenya, and Tanzania. But of course, like we are getting a few businesses from other regional countries like Malawi and stuff like that. So we are building partner network in these regional countries as well as through our distribution channels. And we are getting good business from the region, primarily Kenya, Uganda, Tanzania, Malawi, and the East African region.
There's another question. What are your strategies to overcome forex loss? Okay, so now that the question was raised, I'll probably go into a little bit of details. If you look at our normalized EBITDA margin in Q4, we ended at negative 7.8%. If you look at slide number 2, you'll see that we have continuously achieved improvements, ending up at about minus 6% in Q3 of this financial year. But like I said at the start, there has been a reversal. Our estimate is that we roughly took a 350 basis points hit on our EBITDA margins because of the strengthening LKR currency. Obviously, 70% or so of our costs are in LKR, the currency that strengthened last quarter, with about 90% of our revenues in USD or USD linked form. From a forex loss mitigation point of view, I think it still remains the reality still remains that we are on a favorable currency exposure from a long-term basis, meaning on the long run, we would expect the USD to be the stronger currency and LKR to be the weaker currency, thereby obviously giving us a currency arbitrage. The amount of arbitrage, though, in the long run will reduce naturally as the business grows, as we onboard more headcount outside Sri Lanka. So we would see our cost base also over a period of time getting into more USD or USD linked currencies. From a management effort point of view, I think we strongly believe that the growth that is being generated is going to more than compensate for any of these short-term margin reversals that we would experience because of LKR strengthening that we experience in Q4. In fact, we closed Q3 at around 326 LKR to the dollar, and we closed Q4 at about almost 296. So there's roughly about a 30 rupee 8% or slightly more than that percentage strengthening in the LKR. I think from a direction point of view, we are firmly still of the view that the currency arbitrage is in our favor, although there might be short-term pain because of these short-term movements. But like I said, the currency benefit that we have in the long run would reduce as we become more of a dollar-driven P&L and net cost base as well. There's another question. What are your expectations for EBITDA and EBIT margins in the next few quarters, and when do you anticipate the margins to break even? So at a EBITDA level, obviously, given the 350 basis point setback caused by the currency, assuming no adverse, no favorable currency movements, assuming current currency levels, we are confident we can get to EBITDA break even in Q2. Some of the hard work done in margin improvements were reversed. Therefore, we are starting one step backwards. Q1 typically is a bit of a slow quarter. Therefore, that would take us into Q2 typically to achieve EBITDA breakeven. When it comes to EBIT margins, it would be more towards the end of the financial year. So approximately 4 quarters from now is where we feel we could hit EBIT breakeven. I think we also encourage our investors and the analyst community to also take these margins in the context of the growth. Like we highlighted at the start, our ARR grew in USD constant currency terms about 50% last year, starting with about a 2 million ARR base, going up to about 3.1 where we ended. If you focus on the cloud subscription line alone inside this ARR, that growth is even higher, almost 55 to 60%. And this is where all the investments we've been making on market development, on sales teams strengthening, and on, of course, on the product has been paying off. And like I mentioned during last investor call, the management target internally is to make sure that our cloud subscription revenue grows 10% quarter on quarter. So, which means once compounded, 10% a quarter would be anything in the range of 40 to 50% on an annual basis. So that's the target that we are working towards, and I would encourage everyone to look at margins and profitability in the context of this growth.
So future plans for deal closures. So the plan in both the regions, we have two categories of partners. One is enterprise level partners, and second is SI companies. So with enterprise level partners, we are working on bigger deals, above 100,000 value deals. Like, so at the moment, like, in our funnel, there are about 15 that kind of deals, like in both the regions. So timing is issue, like, because these bigger deals take time. Now, simple example, even the the bigger deal we closed in Q4, it took almost 9 months to 12 months to closure, like, because those deals should go through the tendering and usual closure process. At the same time, like, the tier 2 partners, SI companies are working on regular closures, and few white label partners as well, giving us, like, recurring revenue quarter on quarter. So both the regions, we have a good set of deals at the moment in the funnel. So we are planning to close a few in this quarter, and, like, a good set of deals in Q2 and Q3.
Also, to add to what Sampath said, if you look at our average contract value at the end of the previous financial year, it was in the range of about $10,000. At the end of FY2024, that number went up to about $23,000. So this is almost more than doubling effect on the average contract value. Now, why this is really important and why we watch this number very closely is, as an organization, in terms of hitting our numbers, we talked about a 10 million ARR target in 3 financial years during last call. We won't be doing 3x or 2x or a significant number more than what we are doing today in number of deals. But where that revenue would come from is the fact that our average contract value will be larger, which means that we would graduate from serving middle market to the high end of middle market and subsequently enterprise level customers in the target markets that Sampath mentioned, both on the MEA and Southeast Asian ASEAN markets. So driving this average contract value to at least the 40,000 range in the current financial year is something that we are closely working on. And like Sampath said, we are getting a really good traction from the partner network, which is a critical element for our growth. And that way we would be becoming a much more efficient and productive company, because we'll be working on larger transactions and we could achieve much larger revenue numbers with much fewer resources.
In
There's
fact, during April 2024, we had a partner conference as well in Colombo. Like, all enterprise level partners participated. We had a very good event that built the confidence and trust on the partner network as well. So that help us, of course, like, current financially and going forward.
There is one question on the IPO. Proceeds of 350 million remains for strategic acquisitions. What's the current status? You may have seen an announcement that went out end of March, early April, that we are basically considering a few options there, and we are hoping to present that to the annual general meeting for approval as per the requirements of the Colombo Stock Exchange. However, from a management point of view, there are few things that we are going to be very firm with. That is, we will basically very carefully evaluate ROI before deploying this money, because we have seen very healthy returns on the organic investments that we've done in the past. So we'll be taking that into consideration if and when evaluating any inorganic or strategic acquisition opportunity. So with that in mind, with the current deliberations that are going on, we are confident that we'll be able to announce our plans for these funds in line with the annual general meeting timelines. We have one more question. To reduce risk on staff, has the company considered share options as a larger means of remuneration? Very much so.
Yeah.
I think I fail to recall the exact date, but around 15 months ago, 12 to 15 months ago, the company launched an ESOP scheme and obtained shareholder approval via an EGM. So we have outstanding options amounting to about 3.5% of the total shares outstanding of the company in the ESOP scheme. In addition to that, we have probably another 3% or slightly above that of shares coming from a previous ESOP, which are now held in shares form, not in option form, by the senior management team of the company. So all in all, on a if and fully converted basis, once all these options are vested and converted, the management will own almost 6.5 to 7% of the equity of the company. So to answer the question, yes, we are actively using employee share option schemes as a means of remuneration.
At the same time, the current risk levels have gone down actually compared to last financial year. So more or less staff are like, other than migration cases, like, it is more stable considering if you compare with last financial year.
I may also want to add to the ESOP message that some of our advisors that we employ on a consultancy basis to help us on the go-to-market side, to help us on the market development side, have also seen the significant value and accepted these ESOPs as remuneration. So, I mean, going back to the initial objectives of setting up the ESOP was to use share options as a currency to incentivize attraction of talent, and we've been able to achieve that through this scheme.
So, since we don't have further questions, let's wind up the call. Thank you very much for your active participation. If you have any further queries, please let Nilendra or myself aware, like, so we can help you to understand the business better. So we'll meet again during next quarter IR call. Thank you.
Thank you very much.